Welcome back. In this video, we'll be looking at modeling debt. Let's start with a loan used to fund startup costs, like paying for IT equipment. Let's say this will be drawn and it's for a limit of $50,000. Now remember, there are two types of loans: those that are drawn immediately, where you receive cash straight away, and those that are undrawn or held in reserve like a credit card, available to you when your need arises. The fund working capital field relates to undrawn loans like credit cards or line of credit for everyday costs of running the business or the working capital. This is not relevant for a drawn loan. Our startup loan starts in the first month and is paid off in 3 years or 36 months. This field allows you to extend the length of the loan upon expiry. In other words, by the end of 3 years, it'll assume you refinance the loan at the same terms. Here, let's turn it off. Let's say the bank also gave us an interest-only period of 2 years, meaning we'll only be paying off the principal in the last year. The capitalization period refers to some loans where you do not need to pay interest for a certain period, and the interest is simply added to the loan total. This is a feature common in construction-type loans, where interest incurred during construction will be rolled into the loan because the business will not have any income during this period. This only applies to undrawn loans, so again, not relevant in this example. Recapping what we've done here, we've set up a $50,000 loan where the bank gives you cash immediately in month 1. The first 24 months is interest only, and the principal will be repaid in the last year. Now onto fees. Let's say the interest rate is 7% a year. Commitment fees are often required for undrawn loans, so not applicable here. Finally, upfront fees. Again, it's something that banks often charge and is basically a one-off starting fee for the loan. Here, let's say 1%. The banks sometimes charge account maintenance fees as a percentage of the balance. Let's say it's 0.5% a year. Let's try one more, this time an undrawn loan, used to fund coffee carts. Let's call it equipment loan. Let's set it to the limit of $30,000 and let's turn off working capital funding. Remember to link the vehicles to this loan. This is done by going back to the relevant asset and under debt tranche, selecting the relevant loan. We've done this in the previous video covering assets. Note, once this link is in place, the loan will be used not just for new assets but also for replacement assets. Again, this begins in the first month, expiring at the end of year 3. This time, let's switch on automatic refinance and increase the interest-only period to 36 months, which is the entire duration of the loan. Let's also set the capitalization period to 12 months. So let's explain what we've done. We've set up a $30,000 loan that is only used for buying coffee carts. So as we purchase more coffee carts, the model will keep using this loan until it hits its $30,000 limit. In the first 12 months, any interest and fees will not be paid but simply added to the loan balance. The interest-only period is the same as the loan tenor, meaning no principal is repaid at all. At the end of the loan, the full outstanding balance will be refinanced into another loan. Let's say the interest is 5%. Commitment fees are 0.5% with no upfront or maintenance fees. In the last example, we've set up a line of credit that will be used to fund day-to-day operations. This is done by turning on the fund working capital switch. That's all for debt modeling. In the next video, we'll be covering tax and cash management. Thanks for watching.